Hello, good morning. It's Thursday the 20th. I'm FX Plu. Hope you can see me. It's an early start. I've got to take Bertie to the vet this morning. Anyway, Andrew Bailey's been on. He was providing evidence to the Treasury Select Committee yesterday, and he remains concerned about the pace of inflation. And rightly so. December CPI was up to 5.4%, which is the highest since March 1992, a 30-year high, and crikey, that makes me feel old. It was only April 92 when John Major became Prime Minister. Feels like yesterday. The MPC raised rates in December and the market expects 3 more hikes this year, but Bailey has 2 main concerns. One, energy prices continue to rise. The wholesale gas price has quadrupled in the last year. And 2, inflationary pressure is creeping into wage negotiations. Wage pressure is fairly limited and pretty manageable for the time being, but that's sure to change once the trade unions step up to ensure that wages for their members keep rising in line with inflation. And energy is the near-term concern. Those prices could remain higher for at least the rest of the year. The outlook has extended as the market has come to terms with the voracious appetite for energy, particularly in Asia. The other rather delicate issue affecting energy is Russia. And, of course, the situation developing in Ukraine. Keep an eye on that one. In the markets, yesterday's inflation data helped sterling rally. We saw 136.50 against the dollar and 120.25 against the euro. Over in the US, there are growing concerns about how the rate tightening cycle may affect the monetary relationship the US has with China. China is now the most significant lender to most emerging economies across the globe. The dollars stockpiled from their trade surplus are being used to ensure a continued supply of raw materials continues to fuel their growth. But as interest rates rise, nations that are heavily indebted to China may begin to find pressure for additional support to continue repaying the loans. None of that will distract from the Fed's efforts to bring inflation under control. That remains the primary goal, alongside continued economic recovery. And the normalisation of policy is now seen as rather overdue. The markets also remain focused on employment. Today we'll see if weekly jobless claims have indeed bottomed out around the 200,000 level. Data increased to 230,000 last week, but the market is looking for anything between about 210 and 220 this week. Euro dollar was treading water a bit yesterday, either side of the 113.50 level, but the weekly jobless data today may help that one jolt out of the doldrums and break one way or the other. Keep an eye on that, and do join me again tomorrow. All the best.
If you do not have a clue, then just tweet through and ask FX Blue.